Welcome back. In this session, we'll explore shares, also known as stocks, one of the most exciting ways to grow your wealth. Shares represent ownership in a company, and by the end of this lesson, you'll understand what shares are, the types available, how to invest in them through the Nairobi Securities Exchange, NSE, and the potential rewards and risks. Let's get started. What are shares/stocks? Shares or stocks represent a unit of ownership in a company. When you purchase shares, you're essentially buying a piece of that company. This gives you the right to participate in its success, typically through dividends or capital gains, then sometimes even a say in how the company is run through voting rights. Think of shares as a way to partner with companies you believe in. For example, when you buy shares in Safaricom, KCB, or Equity Bank, you're investing in their future growth and success. Types of shares. There are two main types of shares you can invest in. Common shares. These are the most popular type of shares. As a common shareholder, you have voting rights in company decisions, like electing board members. You can earn money through dividends, profit sharing, and capital gains, selling your shares at a higher price than you bought them. However, common shareholders are the last to be paid if the company faces financial difficulties. Preferred shares. These are less common but offer fixed dividend payments, making them more predictable than common shares. Preferred shareholders don't usually have voting rights, but they are paid dividends before common shareholders. If the company is liquidated, preferred shareholders have a higher claim to assets than common shareholders. Investing through the Nairobi Securities Exchange, NSE. The Nairobi Securities Exchange, NSE, is Kenya's official stock market where shares of publicly listed companies are bought and sold. Here's how you can invest. Open a CDS account. A Central Depository and Settlement (CDS) account is required to trade shares. You can open one through a licensed stockbroker or investment bank. Choose your stocks. Research and select companies you want to invest in. Look for companies with strong financial performance, good growth prospects, and industries you understand. Place your order. Use your broker's trading platform to buy or sell shares. You can also set limits on the price you're willing to pay or receive. Monitor and adjust. Track your investments regularly. Over time, you may need to adjust your portfolio to align with your financial goals. The NSE also offers resources and tools like the NSE app to help you stay informed and make smarter investment decisions. Dividend payments and capital gains. When you invest in shares, your returns come from two main sources. Dividends. Companies share a portion of their profits with shareholders as dividends. For example, if you own 1,000 shares of a company that declares a Kenya shillings 5 dividend per share, you'll earn Kenya shillings 5,000. Dividends can be paid quarterly, semi-annually, or annually. Capital gains. This is the profit you make when you sell your shares at a higher price than you bought them. For example, if you bought shares at Kenya shillings 50 each and sold them at Kenya shillings 80, your capital gain is Kenya shillings 30 per share. Both dividends and capital gains make shares an attractive option for building wealth. Risks associated with stock investments. While shares can offer significant rewards, they come with risks you need to understand. Market volatility. Share prices can fluctuate due to changes in the economy, industry performance, or even global events. Company performance. If a company underperforms or faces challenges, its share price can drop, affecting your investment. No guaranteed returns. Unlike bonds, shares don't guarantee regular income. Dividends depend on the company's profits, and capital gains depend on market conditions. Liquidity risk. Some shares may not be actively traded, making it harder to sell them quickly. The good news is that with proper research, diversification, and a long-term perspective, you can manage these risks effectively.